Howdy, Jacob here. Today we're looking at automatic data processing in the professional services industry. Just under 100 billion market cap, just over 100 billion enterprise value, founded in 1949. They provide cloud-based human capital management solutions worldwide. I know my company uses them for HR and everything. Very consistent growth. So we're looking at probably 7% CAGR over the last 10 years, with gross margins increasing and operating margins increasing and return on invested capital increasing. So we're looking at really all positive notes from their balance sheet. Has 2 billion cash on hand with zero short-term debt, roughly 3 billion long-term debt. So we're looking at uh, a billion net, and their long-term debt can be paid off in just about a year of their 5-year true cash flow, maybe a year and a quarter, year and a half. So no concern with the debt. We're looking at a lot of positives here. We do see property and plant increasing, meaning they are reinvesting back in themselves, which we can also see through their investments going up quite a bit. So they're reinvesting what looks to be on a 5-year average basis, roughly, let's say 50% of their free cash flow, with um, their share repurchases being maybe, what is that, a third roughly, and then their dividend being a lot. So has their cash position been going down? How are they able to afford all that? Okay, I guess they've issued a little bit of debt here. So use of cash without taking into consideration debt, you're probably looking at maybe 50% dividend and then a quarter reinvestment, a quarter share repurchases. So they are using a lot of their money, which is good. You don't want them sitting on cash, since that's part of your investment, is what they do with the cash that's coming in. And so for them to be reinvesting that much, I mean, that's a very positive sign. That means that they're finding things to reinvest in. And as you can see historically, they've been getting a fantastic return on the money invested in the business, both increased margins and increased revenue. So you're looking at a lot of positives here. Share repurchases and dividends by giving money back to the shareholders. So we're looking at a lot of positives here. This is a fantastic company. Let's make some assumptions. On the growth side, I mean, 7% CAGR. I think they could do that in the next 7 years. I mean, they've been reinvesting like crazy. I'm going to put a 20 PE, pretty high compared to what I've done historically. But I mean, when you have a company reinvesting a third of their free cash flow with the capabilities of 30% return on that money, that's pretty positive. I think people are really liking that. They're liking the consistency. You have as low as 3.7% year over year growth to as high as 10%. So that margin of revenue growth is very consistent, with very consistent operating margins, very consistent gross margins. And like I said, people who invest love consistency. Think about it. If you have a bond, people, that's why bonds are safer, and people would pay less for a bond to give it, or people would pay more for a bond versus a stock, all else equal, due to the fact that the return is more consistent. So would I rather make 5%, or the possibility of making 5% a year in a stock, or 5% a year in a bond? Well, the bond is a lot safer. The risk is a lot lower, and so why would somebody add the extra risk of investing in a single company based on earnings when they can just get 5% from? And this example was debt free or risk free, let's say 5% from the government. uh, I mean, people, you got to weigh out the balance of risk and return. And here, I mean, you're looking at a pretty safe company. So I do think that deserves a premium, along with the other things that I've brought up. And for margins, I feel pretty comfortable doing maybe 18%. So 1% share repurchases would be about $1 billion. Take into consideration stock-based compensation, look at about 1.2 billion. And I do think that that's pretty reasonable. So let's say they keep that going. The dividend, I don't want them to increase the dividend, but I'll increase it just because they've done that historically. Let's increase that, I guess, with a little bit lower than their revenue growth. So at the end of 7 years, maybe you're looking at a third for a dividend reinvestment, share repurchases, rather than more like 50%, 25-25 of dividend, share repurchases, reinvestment. And here we just get to a price that's a little frothy. And again, kind of makes sense. You're looking at a 27p currently. We're dampening it to a 20%, and the growth does not outsubstantiate our discount rate. So really no surprise there. But I do think that it's not very difficult for companies to fall 50%. If you look at the company's stock prices, they're very volatile. 50% range in a year is pretty common for a lot of companies. And so I don't think it's unreasonable to say that we could possibly, get to stock at a, maybe not this price, but as the fundamentals get better, at a more appropriate price than what we're seeing here. But do hope you enjoy the video and have a great rest of your day. Thank you.